In today's video, I will discuss wash trade rules. You will learn what is a wash trade, why people are doing it, and I'll bring up also a practical example of a wash trade. So let's jump right into today's video. Hi and welcome to FinCrime Agent. This is my YouTube channel where every week I publish a new video to boost your awareness about AML and financial crime prevention. Let's start by discovering what is wash trading. Wash trading, which is also known as round trip or round trading or even wash sale, is an illegal trading technique that essentially consists of buying and selling a financial asset or commodity, or even multiple assets and commodities during a considerably short period of time. Usually, the main purpose of wash trading is to create the illusion that there is a fake demand for those assets traded and therefore increasing or decreasing the market value of those assets. This is considered a form of market manipulation, as it would influence the price of assets unfairly for other traders as a result of those fake trading activities. Another reason why wash trade can take place is to illegally generate extra fees for brokers. The method used is the same, buying and selling the same asset or shares in a short period of time. However, in this instance, the main objective is to generate more commissions that will end up in the broker's pocket. A wash trade scheme like the one I just mentioned was seen, for example, in the Libor case. Trade activities linked to this investigation were brought to light in 2012, where several international financial institutions were accused of using wash trade transactions with the aim to collude and manipulate the Libor rate over a number of years. Let's see what is required for transactions to be actually classified as wash trades. As I just mentioned, a wash trade implies that an investor buys and sells assets and securities within a short period of time. However, the definition of wash trade takes into account two fundamental elements in order for a wash trade to be classified as such. The first one is the intent. Those parties participating in a wash trade must have intended for at least one person involved in the transaction to do so explicitly for that purpose. The second element is the result. The transaction must effectively result in a wash trade. This implies that the investor bought and sold the same asset for the account holder within the same common beneficial ownership at the same time. The level of risk that is presented to the investor as part of his or her trading activities is another angle that you can use for your understanding of what could be classified as a wash trade activity. An easy rule of thumb is that essentially a trade is considered a wash if it does not change the trader's overall market position in the security or expose them to any type of market risk. So, are wash trade operations illegal? Yes, wash trade is indeed an illegal trading practice. From a law perspective, you can refer to several regulations forbidding wash trade activities. The Commodity Exchange Act, Section 4CA, for example, clearly prohibits wash trade. Also, another reference at regulation level on wash trade is provided by the Commodity Futures Trade Commission, as they define wash trade rule as entering into or purporting to enter into transactions to give the appearance that purchases and sales have been made without incurring market risks or changing the trader's market position. Before we dive into how to avoid ending up breaking wash trade rules, if you're finding valuable this video, make sure you subscribe to FinCrime Agent and press the thumb up on this video. This will make it very easy for you to consume new videos going live on my channel, and your action will help my content to be seen more on YouTube. So thank you for your support. Let's now see a practical example of a wash trade. In this example, we have a stock trader called Sam and a brokerage firm that are orchestrating together market manipulation. They are buying and selling stock of company ZZY in a short period of time. Investors on the market will start to see the increased volume of trading activities for the ZZY stock, and they will also decide to buy more shares of company ZZY. While genuine investors are buying more assets or shares in company ZZY, of course its price will go up and Sam, the trader, will make profit from the increased price as well. Sam will then be in the position to also short sell ZZY stock, further profiting from the declining prices of ZZY as he stops his illegal wash trading operations. As you have learned by now, wash trading is prohibited and is an illegal trading practice, but sometimes it can be quite simple for an investor to slip into the wash trade trap unintentionally, particularly when it's time to accept losses. As a result, in order to avoid making an illegal trade, you must pay great attention when you acquire and sell your assets. If you are an investor, being aware of what makes a wash trade is the easiest method for you to prevent and avoid being involved in wash trading. One final note is that in this video I have covered wash trade rules with example and references specific to the stock market, but this is also a scheme that has been present quite heavily also across the cryptocurrency sector, with crypto trader adopting pretty much the same principle highlighted in my video. And with that, I'm now at the end of this video focused on wash trade rules. Please leave any feedback or comments about my video in the comment section down below of this video. Also, remember to check the description of this video to find links and references from my research on wash trade rules. You will also see there a link to my Patreon page where you can receive copies of my presentations and support the development of my FinCrime Agent project on patreon.com/fcagent. And lastly, thank you for watching. I hope you have enjoyed today's video, and until next time, see you soon.